last year, buyers are getting more comfortable with about the rate that we're at now, right? And we're in that 6 to 7% range and have been for a little while, even as it fluctuates. And so for me, I think that there's an amount of time it takes for people to tolerate such a change. And then after that period of time, then it becomes less of a big deal, whether it changed a quarter of a point this way or a quarter of a point that way. The fact that it doubled last year, obviously we saw that create a high level of sensitivity. The other thing I would say, Bruce, is sometimes these articles can be written in such a way that are a little confusing, right? It sounds like the rate volume is up dramatically. Well, it's up more seasonally from March to February, as we're used to seeing, about 15 percentage points. But it's still actually down dramatically from last March, 40% down, as a matter of fact, compared to March of 2022. So I only say that because as we're trying to understand what's happening in the national market and then certainly in our local markets, we should be looking at trend lines much more so than we're looking at a change from day to day. Because unless it's dramatic, we want to know where it's going and where it's been, not necessarily having whiplash on a daily.
Interest rates are tied to the 10-year yield from the Treasury bills, the 10-year Treasury and the yield that it does. So as money pours into the bond market, right, as people get nervous about inflation and the volatility of the stock market, they tend to take that money out of the stock market and put it in the bond market. And what that means is as people are buying bonds, the price of bonds goes up and the yield drops. And when the yield drops, so do interest rates. What I think we're seeing here, Chase, people are still concerned that we could have a real recession ahead of us. There's one camp that says, oh, we're out of the woods and things are going to be awesome and, we're going to be good. But there is also the other piece that says, look, there are a lot of fundamentals. There are red flags showing up. And it's going to be interesting this week. We see the CPI inflation data and retail sales. So that could drive another volatile pricing week, depending on what data comes out. We've just got to be observant of this. As the investment market looks and says, okay, we're going into recession, you're going to see more money flooding into the treasuries and out of the stock market, which actually could drive interest rates lower.
Sales are down, total number of sales are down in the marketplace, and yet the right homes priced correctly are still selling quickly, right? And actually Redfin reported that nearly half are selling within 2 weeks. So half of the new homes coming to market are selling within 2 weeks. That means the other half aren't. And I think this demonstrates a key point, Bruce. One of the things that you often remind us of on this podcast, and wisely so, is that the local real estate agent, their business doesn't have to participate in whatever's happening in the market. That's actually up to them and the action that they take. There's more than enough sales in their market to hit any goal that they have. Well, same is true for the home seller. When homes are sitting on the market and experiencing price reductions, yours doesn't actually have to. If you prepare it well for the market, you put the best piece of inventory out there you can, and you price it right from the start, you can actually have a whole lot of competition for your home, regardless of what's happening with inventory. And I think that's what this story is really